Let's be real. Over the past few weeks, something massive has happened, and most people still don't fully understand why their portfolios are bleeding. The Nasdaq just entered correction territory. The S&P 500 is down more than 7% from its record high. Oil is surging, bonds are falling, gold is falling, even the safe havens aren't safe. And it all traces back to one thing: the Iran war. Today, I'm going to walk you through exactly what happened, why markets are reacting the way they are, what the historical data tells us, and what smart investors are actually doing right now. No fluff, no panic, just the facts, and what they mean for your money. Let's get into it. Section 1. What actually happened? On February 28, 2026, the United States and Israel launched joint military strikes against Iran. The operation, codenamed Operation Epic Fury, targeted Iranian leadership and military infrastructure in a coordinated attack involving stealth aircraft and precision-guided munitions. The strike killed Supreme Leader Ali Khamenei. Iran did not sit still. Within days, Iran launched retaliatory missile and drone strikes on U.S. and Israeli targets, as well as Gulf states hosting American military forces. Airspace across the region began to close. And then the most economically critical thing happened. Traffic through the Strait of Hormuz, effectively, shut down. Now here's why that matters more than almost anything else in global markets. The Strait of Hormuz is a narrow waterway between Iran and Oman. It is the single most important choke point for global energy supply. Roughly 20% of all global oil and liquefied natural gas passes through it every single day. Think about that. 1/5 of the world's energy supply, gone, effectively overnight. What began as a geopolitical event had instantly become an economic crisis. Section 2, the oil shock explained. Let's talk about oil, because oil is the center of gravity for everything that's happening in markets right now. When the Strait of Hormuz was shut down, Brent crude oil prices surged. As of this week, Brent crude rose more than 5% in a single day, settling above $108 per barrel. U.S. crude came in around $94 per barrel. Analysts at LPL Financial put it simply, it all boils down to oil markets and the implications on inflation. There's really no clarity on when this war will end. And they're right. The uncertainty is the problem as much as the actual supply disruption. Now, the IEA, the International Energy Agency, has called this the greatest global energy and food security challenge in history. That's not hyperbole. The Strait of Hormuz closure has been described as the most severe global supply disruption since at least the 1970s. The comparison most analysts keep coming back to is the 1973 OPEC embargo, the oil crisis that helped define an entire decade of economic misery. And while the world is less energy dependent today than it was in 1973, the shock is still enormous. Here's the chain reaction. Energy prices spike, leads to transportation costs go up, leads to food prices go up, leads to manufacturing costs go up, leads to everything gets more expensive. That feeds directly into inflation. But here's the nightmare scenario, the one keeping investors up at night. What if we get higher inflation and slower economic growth at the same time? That's called stagflation, and the Iran war has put it firmly back on the table. If you're finding this helpful so far, drop a like. It really helps the channel. Section 3. How markets are reacting. Let's look at exactly what's happened across asset classes, because this isn't your typical market sell-off. This one is unusual and more dangerous. Stocks, the Dow, S&P 500, and Nasdaq are all heading for their worst month in over a year. The Dow fell 469 points in a single session. The S&P 500 had its worst day in 2 months. The Nasdaq officially entered correction territory. That's a drop of more than 10% from its recent peak. The MSCI World Index, which tracks global stocks, is down more than 5%. The VIX, the so-called fear gauge that measures market volatility, hit its highest point since Liberation Day tariffs nearly a year ago. Translation: investor fear is at an extreme. Bonds. Here's where it gets really concerning. When stocks fall, investors usually rush into bonds as a safe haven. That's not happening this time. Bond prices have also fallen this month, pushing Treasury yields higher. Why? Because rising oil prices are reigniting inflation expectations, and the bond market is repricing for fewer, or no, rate cuts from the Federal Reserve. The Fed, which was expected to cut rates in 2026, now has its hands tied. Traders are currently pricing in 0 rate cuts for the rest of this year. The first possible cut has been pushed to at least Q3 2026 at the earliest. Gold. Gold has been one of the most shocking stories. The traditional crisis metal has actually fallen nearly 17% this month, on track for its worst month since October 2008. After peaking above $5,400 per ounce earlier in the conflict, it has since pulled back sharply. Why? Partly because the US dollar is strengthening, and dollar strength typically pressures gold. The US dollar. The dollar has risen about 2.4% this month, emerging as one of the few genuine safe havens in this storm. But even that creates problems. A stronger dollar hurts emerging market economies and adds pressure to international stocks. The bottom line: bonds fell, gold fell, stocks fell. Investors are struggling to find anywhere to hide. Section 4. The stagflation trap. Let me explain why the word stagflation is so scary and why markets hate it more than almost anything else. Normally, when the economy slows down, the Fed can cut interest rates to stimulate growth, and when inflation heats up, the Fed can raise rates to cool it down. Stagflation forces the Fed to choose between 2 bad options simultaneously: cut rates to support growth, and inflation gets worse. Raise rates to fight inflation, and you slow the economy further. Morgan Stanley's strategists described it clearly. When inflation is the main fear, stocks and bonds can fall together rather than offsetting each other. That destroys the traditional 60-40 portfolio logic that most investors have relied on for decades. Here's why this is particularly painful for markets right now. At the start of 2026, the story was supposed to be simple: strong earnings, AI-driven productivity gains, policy support, rate cuts, stocks higher. Instead, even before the Iran war, markets were already getting nervous about AI spending and whether the AI build-out would ever pay off. Then, the Iran war added a massive new layer of uncertainty on top of that already fragile setup. Higher energy costs act like a tax on consumers, squeezing their spending power, while simultaneously compressing corporate profit margins. The result: stocks look less attractive as earnings prospects dim, and bonds don't provide the usual cushion because of inflation pressure. That's a genuinely difficult environment. Section 5. Global ripple effects, 10 o'clock to 12 o'clock. This isn't just a US problem. The Iran war is reshaping the global economic landscape. Asia is most vulnerable. Asian economies are heavily dependent on Middle Eastern energy imports. Japan, South Korea, China, and India all rely enormously on oil passing through the Strait of Hormuz. South Korea has separately expressed concerns about the redeployment of US THAAD missile defense systems from Korea to the Middle East, effectively reducing its own security umbrella. Europe is also exposed. Energy costs are rising across the continent, and the European export-driven economy is particularly sensitive to slowing global growth. Equity markets in Asia and Europe are seen by Charles Schwab analysts as more vulnerable than US markets in the near term. Emerging markets are getting hammered. India, for example, is seeing both rising energy costs and falling remittances from Indian workers in the Gulf region. Sri Lanka reintroduced fuel rationing. Bhutan saw citizens lining up outside fuel stations. Smaller economies with less cushion are feeling the shock faster and harder. Tourism in the Eastern Mediterranean, countries like Turkey and Greece, has been sharply disrupted as holidaymakers avoid the region. The ripple effects are spreading far beyond the immediate conflict zone. The defense sector is one of the few winners. The U.S. arms industry reportedly quadrupled weapons production to meet demand. Defense contractors, drone manufacturers, satellite companies, and missile defense firms are seeing increased government spending, and their stocks are reflecting that. And there's a broader geopolitical question lurking in the background. Does this war accelerate a global shift away from US dollar-dominated trade and finance? Some analysts think it does, and that the long-term implications could reshape global capital flows for years. Section 6. What history tells us. Here's where it helps to zoom out and look at the data, because history has a lot to say about how markets behave during geopolitical crises. Research firm Defiant Capital Group analyzed 40 major geopolitical events spanning 85 years and found a consistent pattern. In the first month after a major shock, The S&P 500 lost an average of only 0.9%, but over the following 6 months it recovered to gain an average of 3.4%. The lesson that keeps repeating itself: selling into a geopolitical crisis is almost always the wrong move. The investors who get hurt most are the ones who sell during the downturn and then miss the recovery. Markets have historically posted gains during wartime, including double-digit gains in the 3 to 6 months following both Gulf Wars, led by the defense sector. But here's the important caveat. The variable that matters most in this conflict isn't the military events themselves. It's the energy shock. Analysts point to the 2022 Ukraine war as the closest comparison. That conflict ultimately delivered a 25% drawdown over its full arc, driven by energy prices. The duration of the Strait of Hormuz disruption is the single most important variable to watch. The longer it stays closed, the greater the economic damage and the harder the recovery. Ed Yardeni of Yardeni Research, one of Wall Street's veteran strategists, summed it up this way: geopolitical crises in the past have almost always been buying opportunities. But he also acknowledged that this conflict is different in scale from others that markets have shrugged off recently. These are not sideshows, he said. This is about as big as it gets. Section 7. What investors are actually doing. So what are the smart money managers actually doing right now? Let's be concrete. Staying the course. Most financial advisors and major institutions are telling long-term investors not to panic. If your portfolio was properly diversified before the conflict began, the right move is usually to hold steady. As one advisor put it, it's very easy to say buy low and sell high, but when the moment to buy low shows up, it means something scary is going on. Rotating into winners. Portfolio managers like Gautam Chadha at RBC Wealth Management have been shifting towards sectors that benefit from regional turmoil, specifically fertilizer producers, defense manufacturers, and helium suppliers. The logic is straightforward. Geopolitical disruption creates demand in specific areas, reducing exposure to consumer-oriented stocks. Consumer spending gets hit hardest when energy prices rise and inflation squeezes real incomes. Analysts at Morgan Stanley recommend using proceeds from consumer-facing positions to rotate into industrials and materials. Adding defensive allocations, gold, despite its recent pullback, remains a long-term defensive holding. Real estate investment trusts, REITs, infrastructure, and hedge funds are also being highlighted as portfolio stabilizers, watching for the off-ramp. Here's the most important thing to understand about where markets are right now. Earlier this week, President Trump announced that the US and Iran were in negotiations right now and signaled a potential deal. Markets rallied immediately, oil fell, stocks jumped, even though Iran denied being in direct talks. That single piece of news moved markets significantly, which tells you exactly what investors are waiting for. Any credible sign that the Strait of Hormuz is about to reopen. If we end up with oil tanker volumes going up, markets would be thrilled, said Robin Brooks of the Brookings Institution. When that happens, and assuming it does, expect a sharp and potentially rapid recovery. Section 8. What you should do. Let me close with the practical part. If you're watching this and wondering what to actually do with your money, here's a straightforward framework. If you're a long-term investor, decades from retirement, the data strongly supports doing nothing reactive. Every major geopolitical shock in history has been followed by recovery. The investors who stay invested come out ahead of the ones who flee. Consider whether this is actually an opportunity to dollar cost average into positions at a discount. If you're 5 to 10 years from needing the money, be more thoughtful. Rebalance if your allocation has drifted. Consider trimming concentrated positions in sectors most exposed to inflation and slowing consumer spending. If you need money soon, this is genuinely harder. Advisors recommend taking only what you need, leaving the rest invested to recover. Avoid selling everything at once. The market will likely look very different in 12 to 18 months. Across all timeframes, diversification is your best friend right now. International funds, real assets, energy-adjacent holdings, and defense sector exposure have all provided cushion. If your portfolio was concentrated in domestic large-cap tech before this started, this is a good moment to rethink that. And finally, avoid making decisions based on headlines. This conflict has already produced multiple fake rallies on peace deal rumors that turned out to be premature. Discipline beats reflexes every time. The Iran war is not a sideshow. It's the most significant geopolitical and economic shock in years, potentially decades. The Strait of Hormuz closure has triggered an energy shock that's feeding into inflation, complicating the Fed's path, hurting consumers, and leaving investors with few places to hide. But history is also clear. These moments pass, markets recover, and the investors who understand what's happening and stay disciplined come out the other side in better shape than those who panic. Stay informed, stay diversified, and don't let the headlines make your portfolio decisions for you. If you found this valuable, make sure to subscribe so you don't miss the next video.